All right. Today is Monday, June 13th, and this is a recap for the stock market activities last week and an outlook for the week to come. Folks, here's the deal. I've been working my ass off all weekend to produce a video for you, the usual Sunday video, and I did exactly that and uploaded the video a few hours ago, but unfortunately YouTube took it off due to a corrupted file, a technical issue, whatever that is. So unfortunately that video is off for now, but what you're about to listen to right now, what you're about to watch right now, is the market coverage portion of that video, which includes the charts analysis. It's important to me to get this out to you before trading starts so you can have an idea on what to look at. Now, the in focus portion of that video, which includes the macro analysis, specifically the CPI review, and I went over the Biden, Jimmy Kimmel interview, I went over the Brian Deese interviews on Friday, I went over the Fed's analysis and the use of the bazooka. Now, I'm going to try to upload that portion of the video right after the bell. So if everything works out as I'm planning right now, you will get 2 videos tomorrow. Well, technically it is today. So you're going to get 3 videos. You're getting this one. You're going to get the CPI review in a separate video, which is the in focus portion from Sunday's video, which YouTube took down. And then on top of that, you get the new video per usual. So this is the plan for now. I apologize in advance. It is what it is. Thank you for your support. Let's move on. And here it is. We start with the market performance last week. And here we go. On Friday, the Dow Industrial Average was down by 880 points even, or a decline of 2.73%. The Nasdaq down big by 414.20 points, or a decline of 3.52%. The S&P 500 in the red, big time, down by 116.96 points, or a decline of 2.91%. The sector's performances on Friday, down across the board, no metals here, shame on all of them, yet the declines were led by technology, cyclicals, and financials. Let's contrast this with the weekly performance of sectors of the market. Again, all of them are down, even energy was down, and the laggards were led by financials, technology, and materials. So even though rates went higher, financials went down. Why? Because it doesn't matter. A recession is happening. Banks are not going to do good in a recession, even if interest rates go higher. The advance to decline ratios, NYSE 14% advancing versus 83% declining. The Nasdaq 16% advancing versus a stunning 81% declining. Commodities, what's going on here? On Friday, it was a bloodbath. Now, why was it a bloodbath? Why would commodities go down when the CPI comes out exceeding expectations? The answer is because the commodities market is now saying, watch out, the Fed is about to release the bazooka. No excuses now. The Fed has to be super aggressive. If they become aggressive, commodities will go down. And therefore, crude was down, both the WTI and Brent down about 1% apiece. Gasoline, the RBOB, was down around 2.75%. Heating oil was down a little over 1%, and then natural gas giving up some of the gains, losing about 2.25%. Now, here's the problem with natural gas, which fed the recent rally in the commodity, adding unneeded but much appreciated tailwind for natural gas investors. And this event is the fire that is going on at the Freeport LNG export terminal, which happens to be the destination from which U.S. natural gas is exported to European destinations. When we talk about softs, down across the board, more pain for lumber, down a little over 2%. Similar story for sugar. Coffee was down almost 3%. Even cocoa was down around 2%. Cotton was down a little over half a percentage point. And then OJ, the outlier for the day, closing in the green with gains of a little over half a percentage point. Metals. The interesting action is the dollar went higher, so you put 2 and 2 together, gold should go down along with copper and the majority of metals. Indeed, copper went down, losing about 2.25% on Friday. We saw muted action in palladium, platinum, yet we saw gains this time around by precious metals, silver and gold, but mostly gold. Gold went higher and closed the day by almost 1.25% worth of gains. And this is an important message, but I'm not going to make a big deal out of it right now. I want to see if it's going to stick or not in the next few days. Let's see if the dollar goes higher and if gold continues to go higher. If that is the case, then boy, we're going to see massive pain in the equities market because we're seeing an exodus from risk-on assets to risk-off regardless of what the dollar is doing. Meats, it was a down day for both live and feeder cattle futures. Nothing big, a little over 1% for feeder cattle, but lean hogs closing in the green, rebounding expanding by almost 1% on Friday. What about grains? Down across the board with few exceptions. Muted activities for corn and wheat futures, while soybean meal futures eked some gains here of around half a percentage point. Yet it was a down day for soybeans, soybean oil, rough rice, oats, canola, all down, sizably so. Moving on to the options market, the big casino, what's going on here? The volume moved higher in certain names, chiefly Amazon, Tesla, and Apple, the top three, but we're seeing more put options buying than calls. For understandable reasons, of course, on Friday. Technical violations, the algos reacted, and of course, traders reacted and will react in the next few days by buying puts and betting for more downside in equities. But here it is, the hottest table by far, Amazon at number 1 on Friday at around 2.3 million contracts traded for the name. About 52% of those were calls. And at number 2, Tesla, the souffle at around 1.7 million contracts. Whoa, about 43% of those were calls. They're betting for more downside for Tesla. Breached 700. You got the shorting signal. You bought puts. You're going to double down until we see a reversal. And of course, we're not going to see a reversal until Jerome Powell takes the podium. That's going to happen on Wednesday. In the meantime, at number 3 on Friday happened to be Apple at around 1.7 million contracts. About 51% of those were calls. Here are some of the unusual activities that took place in the options market on Friday. We start with the ticker DAL for Delta Airlines. The CEO came out with a rosy outlook. Of course, if you have an ounce of rationale, you're not going to buy that garbage. But somebody did, and they bought the 38 calls for the expiration date, July 15th, with expectations that the name could move higher by more than 8% by then. They paid around $1.15 a piece to enter this trade, all in all spending around $2.8 million. And then we have the ticker SPY for the S&P 500. They're buying calls this time around, betting for a rebound. I don't see a rebound, at least in the futures right now, but we could get a rebound based on oversold technicals. That's not going to last until, of course, Jerome Powell comes out. But here we have somebody perhaps selling calls. Maybe they own the SPY. They know there is a downside, so they're raising cash by selling covered calls. In this case, the 430 calls for the expiration date, June 22nd, with expectations in case you bought these calls. The SPY will move higher by more than 10% by then. They paid about $1 a piece to enter this trade, all in all spending around $1.8 million. What about the ticker XLF for the financial ETF? Even though yields are moving higher, financials are not performing. Reason number 1, the stock market is crashing. Reason number 2, a recession is coming. This is not going to be good for banks. And despite the talk from the CEOs and Jamie Dimon saying that the balance sheet is a fortress or whatever, in JP Morgan, in this case, we're already seeing a lot of delinquencies and risk-taking by the consumer using credit cards and such. If we're going to head into a recession, it's not going to be a surprise that we're going to see foreclosures, bankruptcies, and less appetite for lending. And therefore, they're betting against the XLF. Despite higher yields, in this case, they're buying the 27 puts for the expiration date, August 19th, with expectations that the name could move down by more than 17% by then. They paid around 50 cents a piece to enter this trade, all in all spending around $900,000. And then we have a put spread for the IWM, small caps, the Russell 2000. They bought the 155 puts and they sold the 135, all for the expiration date, July 1st. And of course, the goal here is for the IWM to move down by more than 13% by the expiration date, but not more than 24.5%. They paid around 45 cents a piece for buying the 155 puts. They received around 10 cents in credit from selling the 135 puts. I don't see the point of selling for 10 cents. Again, I'm working on a video, an options trading video, that teaches you how to get paid to trade by opening spreads in a timely manner. Now that the market is going down, why not open the 155, wait for the IWM to go down, and then open the 135, sell the 135. Now you're capturing higher credit. You're getting maybe 35, maybe more than 45. Now you're getting paid to trade. But anyhow, in this trade, all in all, they reduced the entry price to 35 cents a piece. That brings the total all the way to $500,000. And lastly, what about the ticker RDBX? This is for Redbox. The name is under a short squeeze, but be careful here. Book your gains immediately. Always be closing. In this case, they bought the 15 bucks calls for the expiration date, June 17th, with expectations that the name could move higher by more than 13.5% by then. They paid around $1 a piece to enter this trade, all in all, spending around $1 million. Moving on to the heat map analysis, what's going on here? This is the heat map from Friday, bloodbath across the board, with the exception of what? Gold? That's a surprising move when the dollar is moving higher. But gold miners in the up and up, I'm still holding in gold miners. I bought the dip in gold miners. So far, so good. We have some oil and gas names moving higher. EOG, for example. Then we're seeing certain value names within healthcare, such as Mckesson, GSK, CVS. Even in defensives, the value names such as tobacco, all closed flattish, in the green, but flattish. Flattish is good when you have a bloodbath across the entire map. But notable outperformers, number one, Kroger in defensives. Kroger happens to be my largest holding. I made a video about it a long time ago in 2020 saying that Kroger is the safest stock in the market right now, and it continues to prove my theory correct. But we're also seeing a rebound in packaged food names like Kraft Heinz, Kellogg, General Mills. We went over some of these charts a while ago. They looked bullish at the time, and then came the earnings from Walmart and Target, and all of these names got crushed. But what if they got crushed and it's not deserved? Maybe they're performing good. Maybe the crash, the drop in these names is a mere buying opportunity. We will know if these names continue to outperform if the stock market continues to go down at least all the way to the FOMC meeting. Here's the weekly heat map. Doesn't look a lot different. We're just seeing oil and gas, the refineries performing for the week. Names like Valero, Marathon, for example. And then we have the Chinese names, the rebound in Alibaba, Pinduoduo, JD. I don't think any of these rebounds are going to hold. You have the EV manufacturers from China, Li Auto, outperforming, etc. I don't see that's holding, even though the Chinese economy just reopened, but we're hearing more talk about reimposing the lockdowns again. Now you combine that with the higher inflation reading in the CPI and the US Fed, that's about to be more aggressive. You don't want to be in these Chinese stocks. You got the rebound, you got the short covering, you're done here. What about the heat map from a weekly standpoint for the ETFs? A bloodbath across the board, no surprise here. The only performers are the VIX proxies, UVXY, VXX, the inverse indices such as the SPXS, the SQQs, the TZA, and the only international ETF that managed to outperform for the week, once again, the Chinese ETFs, the FXI, the MCHI, that's not going to last in my opinion. But what about growth versus value? Both are down, no contrast here. And then we have commodities. Commodities, the outperformance came from gold, specifically on Friday, but mostly from natural gas, the UNG, and of course the leverage index, and that one is the ticker BOIL, BOIL. Nothing to see here, folks. Lots of pain. The assumption is the pain will continue until the Fed makes it clear what do they want to do here, and then we'll take it from there. But for now, let's move on to the charts analysis, and we start with the SPY 30 minutes chart. What do we see here? The market did not give us, a lot of us at least, the opportunity to hop in and short. Why? Because the CPI leak happened late Thursday. Unless you got the leak, you kind of missed it. The chart flushed down, the bear flag played out, the chart lost 410 as support, and it lost 405 as support. And then we got the gap down immediately on Friday after the CPI. And all in all, the chart did not give most traders the opportunity to short. It did not give most traders who've been long, betting for a pop higher after the CPI, the opportunity to get out. So lots of pain here, lots of FOMO among the shorts. You have to understand the psychology. Lots of pain among the longs. That means more capitulation, more selling in the days to come, more FOMO by the bears, which means more shorting, more buying of puts, which could exacerbate the move to the downside. We have another bear flag formation by the closing on Friday. It's already playing out. The assumption is we have support at around, let's say, 385. I would be conservative and say 380. Once 380 is broken as support, you're going to see another massive flush down. We might get a rebound based on oversold bases. Look at the 30 minutes chart, for example. The RSI is kind of oversold. Let's say we open down, gapping down at around 385. We could get a rebound. That rebound most likely will be an opportunity to short again. And then we go down to 380. And if 380 is broken, the algos are going to react and we will see a cascading impact of selling. Here's the daily chart for the continuous contract for the SPY, the S&P 500. We now know that the bull flag formation was nothing but a mere bull trap. And the reason is it was dependent on what? On a fundamental case. It wasn't dependent on the technicals, meaning whether the bull flag was going to play out or not was dependent on the CPI. Well, the CPI came out disappointing, so no more bull flag. It becomes a bull trap. The chart lost 4,100 as support. That was a shorting signal all the way to 3,960. But the chart did not stop there. It continues to flush down all the way. We're now looking at the support of 3,855. The volume went higher. The momentum indicators curled down. Matter of fact, we have a crossing for now. Not confirmed yet, but we have a crossing with the MACD indicator. So all signs are leading for lower lows, and the bears regaining momentum. When we look at the weekly chart for the SPY's futures, what do we see here? Obviously, we have a trend line that was broken earlier this year. There was an attempt to reclimb the trend line again that was met with failure. That was your shorting signal all the way down. We got the rebound a few weeks ago, but here we go. That bear market rally did not last for too long, and now we're eyeing what? 3,600. 3,600 should be good support. So if I'm reading the tea leaves correctly, what if the SPY goes down, in this case the futures, goes down all the way to 3,600 by Wednesday? And then Jerome Powell comes out and says whatever he's going to say. The market likes it, and we see a rebound from that point on. We'll see. Here's the Q's 30 minutes chart. What's going on here? Again, the flush down on Thursday got us all the way to the support of 299.28. I was skeptical of that. I was looking at 297.5. It didn't matter because we got a gap down on Friday, violating all of these supports and forming a bear flag pattern, which played out by the last 30 minutes of the day. We're now looking at the support of 285. Let's say 280 to be conservative. If the chart fails to rebound from that point on, or it rebounds based on oversold technicals, then in all likelihood, it's going to reverse and move down again, producing a flush down once the support of, let's say, 280 is violated. The rebound, if it happens, the solid one, the sustainable one, will happen due to the Fed's action. The fundamental case will produce the rebound, not the technical one in this case. How do you confirm the the fundamental case? Whatever the Fed says, if the dollar goes down, if yields cool down, if we see risk on assets moving higher, then you know that we have the Fed bottom, the Jerome Powell bottom. It's not going to be the bottom, but it could be a bottom from which we can rebound for a few days, if not a few weeks. But that will be confirmed by a weakness in the dollar, reversal in the dollar, a cooling down in the 10-year yield, and participation in buying call options. What about the daily chart for the continuous contract for the NASDAQ? Similar story here. We got the flush down. The support of 12,207 is violated. We have the support of 11,689. That's probably not going to hold overnight. So we're looking down at 11,000 and let's say 58.5. But if we zoom out to a weekly chart, same chart, the continuous contract for the NASDAQ, we can simplify that support to 11,000. We have a trend line. We have an ABC pattern. The NASDAQ broken the trend line. We're now looking at 11,000 as support. And the thinking right now, at least among the bulls, is what if the NASDAQ continues to go down, in this case the futures, all the way to 11,000. And then the Fed comes with a rescue, whatever rescue means, and we see a rebound from 11,000. This is what the bulls are hoping for. The bears are hoping for a domino effect of selling, a flush down that violates 11,000 and gets us all the way down to the highs in 2019 before the crash. Could that happen rapidly? Yes, it could, in a crash scenario. What are the probabilities on that happening in just a couple of days before the FOMC meetings? Not highly likely, but if Jerome Powell screws up instead, then we could see a cascading impact, massive flush down candles, and 11,000 will be gone as support, and after that, all bets are on. The IWM, the Russell 2000, from a 30 minutes perspective, what's going on here? If the late day sell-off on Thursday did not make it clear, the CPI leaked, and therefore on Friday, we got a gap down going all the way to the support of 177.85, forming a bear flag pattern. In all likelihood, this chart is going down all the way to 174.22, which is the next support, but keep your eyes on the RSI because at some point it's going to get oversold. The ideal scenario for the bulls is it gets oversold by the time the FOMC minutes comes out and Jerome Powell starts speaking. Whatever he said, whatever he decides, the market likes that, and we see a rebound off oversold technicals and solid rebound such as 174.22. And that combination could create a more sustainable rebound than the one we got before. But if the support of 174.22 is violated, then we have lower lows to come. The problem is, what if Jerome Powell disappoints? The bulls are placing all of their eggs that Jerome Powell will indeed deliver. What if he doesn't? This is what the bears are aiming for. And in this case, in the IWM, when we zoom out to a daily chart, we have a series of bear flags playing out, and we have the gap at around 163.62. Now, the bulls would argue, who cares if 174.22 is lost as support? That is meaningless on a daily chart perspective. The most important number is 163.62. Now, what if what we're seeing right now is a reverse ABC pattern, which could get us all the way to 163.62, closing the gap. Then Jerome Powell comes with a rescue, and we see the Russell rebounding higher. This is what the bulls are hoping for. The bears are hoping for a violation of the support of 163.62, betting that Jerome Powell will disappoint the market even further. Here's the Dixie, the US dollar. What's going on here? It recaptured 103 as support for good now. We have the confirmation. The MACD indicator is firming up, indicating bullish momentum, meaning the dollar could surge higher all the way to 105. But it all depends on the Fed. If the Fed comes out, in my opinion at least, if it comes out with the bazooka of 2.5%, we might actually see the dollar moving down. We might see the market rallying once the market realizes that, okay, now the Fed is serious about tackling inflation. And that could be good for equities. We could see the dollar cooling down because for now, the dollar is saying, I don't know, Jerome Powell is not clear. Inflation could move even higher, and then at some point, the Fed will have to be even more hawkish. But if you have clear expectations by the Fed, by Jerome Powell, saying, hey, we're doing 2.5% right now, and we'll take it from there. If we see the July reading, for example, improving, then we'll continue the course. We'll do 25 basis points from that point on. If it doesn't, we'll ramp up to 50 basis points, maybe more than that. And by the end of the year, we want to get the Fed funds rate to at least 3.5%, if not, better yet, 5%. If he comes out clear, then the chart of the dollar and even the 10-year yield could say, wait a minute here, there is no need to move higher. There is no need to be outlandish with the moves higher, assuming that the Fed will scramble to tighten the policy at some point. Here's gold, the daily chart. What's going on here? It popped higher along with the dollar. The support of 1,845, 840, doesn't matter what it is, still intact. The Fibonacci retracement still intact. Positive momentum on the MACD, on the RSI. Nothing to hate here, unless, of course, if Friday's action was a trap, a glitch of some sort. What about Brent crude? What's going on here? From a 4 hours perspective, we have a pop all the way to 124. The chart is having a hard time breaking above 124. It got a double top for now. The next support should be 118, which could coincide with the trend line in yellow. If the chart fails to rebound from that point on, then the next support becomes 114. Here is the 10-year yield from a daily chart perspective, a pop higher on Friday. No surprise here. The momentum indicators are firming up, positive. Bullish momentum now on both the RSI and the MACD indicators. The negative divergences are gone. We're now eyeing the previous high of 3.2. If that is passed, then we have 3.5. That number could be the target that other traders are eyeing after 3.2 is passed. And then we'll take it one day at a time. But this chart will react one way or the other after the conference of Jerome Powell. That would be the decisive factor, the catalyst for this chart to move up or down. Now, here's an important price action in the TLT, a weekly chart. Even though the 10-year yield popped higher significantly, we did not see a big down day in the TLT. Why? Because there was some buying of bonds. So what happens when the dollar is higher? We see buying of both bonds and gold. That tells us that we're seeing fear. Finally, we're seeing fear. Whether that fear is going to last or not, was it just a one-day phenomenon? This is why we're waiting for a confirmation on Monday. And if fear is about to hit the market, then guess what? The fear gauge, the VIX, from a 4 hours perspective, should pop significantly higher. For now, we have positive momentum in the MACD indicator. And what if this is an A, B, C pattern? We got the A leg, now we're forming the B leg. Soon enough, we get the C leg all the way back to 33, if not more than that. Now, here's a chart we don't talk about often, but the daily chart of the VIX is offering another perspective. Look at the MACD indicator. It is about to reverse negative divergence, negative momentum. It's about to create positive one. We have a sloping line of resistance. The chart did not make it above that line, but once it does, it will produce an explosive move to the upside. So you got the 4 hours chart and the daily affirming a pop in the VIX. What about the 4 hours chart for the VXN, the VIX for the Nasdaq? We're seeing the beginning of the positive momentum in the MACD indicator, for example. No clear pattern here, but if we have a pop, it could get us all the way back to 40. Apple, a daily chart, what's going on here? For one thing, the reverse head and shoulder hopes are now gone. The chart violated the support of 145, not only that, but also the support of 138.79. We're now looking at the previous low as support, and the resistance becomes 138.79. The volume went higher on a selling day. That's a bad sign, but it is a good sign for Apple bears. Likewise, the momentum indicators are curling down. We're about to see negative divergences on both the RSI and the MACD. All of these are signs that the bears should double down on their shorts on Apple, at least all the way till Wednesday. What about Tesla, the souffle? 30 minutes chart. What's going on here? Forming a bear flag pattern. It lost 700 as support. This is a bad sign indicating more losses to come, but Tesla bulls would argue, if you zoom out to a daily chart perspective, yes, 700 is gone as support for now, but not by a lot, and the reverse head and shoulder formation remains intact because the actual low of the left or right shoulder or whatever that is actually a little below 700. So why not wait till that number is taken down? Okay, no problem here. But if on Monday we see Tesla moving down, then the hopes of a reverse head and shoulder formation, a pop, and a rally from that point on is poof gone. And we have bad news for Tesla, by the way. We're seeing the forecast worsening when it comes to the Chinese output in the Shanghai factory, which is leading Tesla to lay off employees and canceling hiring events in China. So this is a bad sign. On top of that, the hammer is coming down on Reverend Elon Musk by the regulators in this country. His scams are pretty much done, just a matter of time now. And in this case, they're recalling the self-driving software. What about Bitcoin? What's going on here? The leading indicator, the risk-on indicator, did not pop, did not participate in any rally in the NASDAQ. As if Bitcoin was saying, don't believe the rally here. Don't believe the rebound in the equities market because I'm not popping higher. Why should equities? We talked about 32,384 you're not going to buy until that number is passed. That number was never passed. Matter of fact, the support of 30,000 was broken. That is a shorting signal. And if Bitcoin doesn't rebound sooner or later, the next destination will be 20,000. That will come hand in hand with margin calls. We will see destruction, not just in Bitcoin and cryptos, but also the margin calls are going to impact equities too. And lastly, I've been a proponent of agricultural stocks in this channel for a long time, since last year. But I tweeted on Friday that I'm done with all of my positions in agricultural stocks. I sold them all. I've been waiting for a 1-year mark before I sell because I don't want to pay short-term gains taxes, but the case was both fundamental and technical in nature. The fundamental comes from the CPI. Inflation is way higher than expectations. The Fed will have to be more aggressive. Why not take your winners? Book your gains from the winners. We don't have a lot of winners in the stock market right now. That's number one. Number two, the technical case, the charts are getting worse. For example, the ticker ADM, Archer Daniels weekly chart, we have negative divergences on both the RSI and the MACD. We have a bear flag formation. Why not book profits now? Another way to look at it, what if this is a reverse ABC pattern? We have lower lows to come. Here's the chart of FMC, another agricultural name, herbicides. I'm done with it now. It took all of my profits, and the reason is we're seeing negative divergences on both the MACD, the RSI indicators from a weekly chart perspective. We have what it appears to be a reverse ABC pattern, which should take us all the way down to the trend line at least. And then we have the ticker MOS, Mosaic. This is a daily chart. We have a head and shoulder formation. And we talked about 59 as an important support. We now have a confirmation that 59 is done. It's no longer support. So in all likelihood, Mosaic could go down all the way to the trend line in yellow. And that would be a steep loss. Why not book profits before that happens? And lastly, we have Nutrien, the ticker NTR from a weekly chart perspective. The fundamental case for this name is a lot stronger than Mosaic. And the reason is Mosaic happens to be mostly nitrogen. Nitrogen is going down in price. Nutrien happens to be more in potash, and that is still holding at elevated levels, but they all trade in ETFs. If one goes down, all of them go down. In this case, from a weekly chart perspective, the volume went significantly higher on the down week. We have negative divergences on both the RSI, the MACD. In all likelihood, the chart is going to go down to the consolidation range highlighted in the box or rectangle, whatever that is in the chart. And you know what? Taking profits at this stage makes you feel good because you don't have a lot of winners year to date. I don't have a lot of longs to begin with anyways. So raising cash, taking profits from the longs, keeping few names, a handful of names in the long portfolio makes me feel a lot better in this uncertainty. If things change, if the outlook becomes rosy again for these names, I can easily pick them up again. So I want you to think the same way in your portfolio. If you have high runners, why not take the profits now? Specifically if you're already past the 1-year mark. And then you can buy them back. If the case changes, you can always do that. But you can't regain your profits once they're already lost. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? On Monday, we have inflation expectations, the 1-year and 3-year from the New York Fed. Tuesday, June 14th, we have the Small Business Index, and we have the PPI, the Producer Price Index. This will be important in combination with the CPI. Wednesday, June 15th, we have retail sales, the Import Price Index. We have the Empire Manufacturing Index. We have the Home Builders Index. But most importantly, the FOMC statement and the conference by Jerome Powell. Wednesday is the most important day for the week by far. Then Thursday, June 16th, we have the initial jobless claims, building permits, housing starts, and the Philly Fed Manufacturing Index. And lastly, Friday, the 17th, we have the Industrial Production Index, and we have capacity utilization. With this, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. And buckle up your seatbelts. I will talk to you again tomorrow.